Ladies and gentlemen, greetings from wherever you're joining us from. It's a delight to have you as part of this conversation where we want to take a deep dive into Kenya's Finance Act 2025. In case you don't have context around this, the Finance Act is the piece of legislation that is designed by Kenya's public finance architecture for the generation of revenue every fiscal year. So we go through this process where we have the finance building table in the House from the National Treasury, and we have a debate around the proposals for revenue-raising measures, where we see tweaks and adjustments here and there across a raft of pieces of tax legislation. To help me take a deep dive into this conversation on Finance Act 2025, I have Fred Kimotho, Associate Director, Tax and Legal at Deloitte. Later on, I'll be giving them a chance to introduce themselves. I also have Jill Nasha, Tax Director at RSM East Africa. And finally, Agnes Gitau, Tax Partner at Anderson Tax Kenya. The way we shall navigate this conversation is that we will begin with a focus on the changes in value-added tax. And the reason why we shall be kicking off with VAT is because a lot of the conversation on Finance Act 25 has been around the cleanup of the first and second schedules of the VAT Act, focusing on exempt status and zero-rated status. After that, we shall transition into a conversation on the Tax Procedures Act and the changes which are coming through amendments to that piece of legislation, another significant portion of Finance Act which elicited so much debate in the public participation phase. And we shall close with a conversation on changes to income tax and excise tax. And that is how we shall be having our conversation tonight. At the tail end, we shall have a Q&A session, and that will take us to right about 9:30 p.m., where we shall be dialing down with closing thoughts. Having set the scene as such, I just wish to caution us that what we have seen thus far is a special settlement coming from the Kenya Gazette office, where we have seen a special notice which came out today, giving us a glance into what we are seeing in Finance Act of 2025. And of course, we are all waiting to see the green copy, which of course will guide us on what's the final position on matters Finance Act 2025. I have set the stage. Now let me invite my panelists to introduce themselves, starting off with Jill Nasha. Please tell us who you are, which institution you're affiliated to, and what you do there.
Thank you, Julians. Good evening, everyone. My name is Jill Nasha. I'm a tax director with RSM Eastern Africa, handling tax as we speak. Thank you.
Thank you very much, Jill. Now let's cross over to Fred Kimotho.
Good evening, all our listeners. My name is Fred Kimotho. I work with Deloitte East Africa as an associate director looking after tax policy and tax controversy. It's a pleasure to have this conversation. Looking forward to an engaging one. Thank you.
Thank you very much, Fred. And finally, let's cross over to Agnes Gitau. Please introduce yourself.
Thank you, Julius. Good evening, everyone. My name is Agnes Gitau, a tax director at Anderson, where I handle tax matters for our clients.
Many thanks, my panelists, for introducing yourselves. We shall be relying on your guidance and insight to help us shed light into nuances around Finance Act of 2025. So let's kick it off, starting with value-added tax. One of the major changes that we saw coming at the Committee of the Whole House stage, and maybe just to take a step back and give context, is the bill is tabled in the House. It goes to the first reading, second reading, and then we go into the Committee of the Whole House, where we see a report coming from the Finance and Planning Committee, after which these amendments are taken to the floor of the House, and we go through a clause-by-clause amendment. And that is where I'm starting from. We saw significant changes because the Finance Bill of 2025 had come with a proposed drastic cleanup of the first and second schedules. The first schedule dealing with VAT exempt status, the second schedule dealing with zero-rated status. We saw the National Assembly differing with the National Treasury and saying, whereas we want to address the headache of tax expenditure, which is the revenue we forego, we still have to retain some products on zero-rated status. Let me start with Fred Kimotho. Help us understand exempt, zero-rated, and standard-rated, and why are you surprised by the U-turn we have seen when it comes to this cleanup? Fred.
Thank you. Maybe to start us off in terms of what exempt means, what zero-rated means, and what taxable at 16% means. Basically, it means that if you're talking about taxable sales from a VAT perspective, is that every sale will be charged at the rate of 16%, which then means that it has to be loaded on the price of the good or the service. From a zero-rated perspective is that you apply a zero rate on the value of the good. And of course, for exempt, it means that VAT is not applicable. The only main difference between exempt and zero-rated is that for exempt, then you are not able to claim the input VAT. And that's why you will hear the argument that if a good is made to be exempt, it becomes a bit more expensive than a zero-rated good. And you'll actually see quite a number of goods in the exempt schedule compared to the zero-rated, because also from a zero-rated perspective, which is something that Julian, you have mentioned, it also means that the government has to refund the suppliers who are supplying zero-rated goods the input VAT that they incurred, the excess input VAT arising from such supplies. So that's the main decision between the three. Now, on to your question in terms of whether we were surprised or not. First of all, it's good to mention that if you look at just the first schedule alone, and more specifically the first part, it has more than 150 goods that are listed there to be exempt. If you go to the zero-rated schedule, you'll actually realize that it has more than 35 items that we're looking at in terms of them being zero-rated. Now, there's this broad pronouncement under the National Tax Policy and the Medium-Term Revenue Strategy in terms of the argument that for zero-rated, what the government aims to do is to ensure that zero-rated are only restricted to exported goods and services, while exemption, it was also expected to be limited to some essential goods and services as well. The question then, given that medium-term revenue strategy was supposed to give us guidance as far as tax changes are concerned within a period of 3 years, sometimes I ask myself whether we set ourselves to vary in terms of, are we saying that the 35 goods and services that are listed under the second schedule for zero-rated would have been removed, all of them, and maybe moved 2 or 3 within a period of 3 years? And I think the answer is no. And that's why, for me, I am not surprised when I saw some of these items being reversed by Parliament. Number one, because there was a lot of public outcry as far as removing goods from exempt to standard rated, because obviously it meant that the price was going to go up. And of course, number two, which is also very fundamental, I think is the choice of the goods that we did choose to remove from these categories. If, for example, look at the items that are being removed from exempt to 16%, you had things like taxable goods on construction of tourism facilities and recreation parks, things to do with construction and equipping of hospitals, locally manufactured passenger vehicles, quite a number of items that you would think by them having been introduced under the exempt schedule, there was a bit of thinking, either in terms of spurring the growth in some of those sectors or other motivation. So the question then would be, is then doing away with some of those things? And of course, when you go to zero-rated, quite a number of things there, things like local assembly of mobile phones, which had actually been introduced by the Finance Act of 2022, electric bicycles, solar and lithium batteries, Finance Act of 2023. So 2 things to note. So in terms of the items that were being moved from exempt to standard rated and from zero-rated to exempt, you actually notice some incoherence with the global government policy. Talk of the net zero emissions that the government is aiming to achieve by 2050. So you then ask yourself, by the government removing some of these items in the category they are in, is it that they are contradicting themselves in terms of ensuring that we achieve some of these particular objectives? But the other one, which is fundamental to me as well, is the fact that some of these goods had just been introduced barely 24 months ago. Quite a number of changes, especially for zero-rated, including some of the things like electric bicycles had been introduced by the Finance Act of 2023. Then the question would be, is it that we have done a bit of study and realized that these goods should no longer be under zero-rated within such a short period of time? So I think, so for me, I'm not surprised. I think then we needed to retain them, majorly to ensure that we don't affect the health sector, which is some of the areas that these items are affecting, agriculture, and also the clean energy agenda. But we hope maybe progressively we will be able to clean up as expected. But I think it should be more informed by policy rather than just committing to some of the pronouncements that have been made in the past without necessarily considering some of the bigger or larger ramifications of those movements. Julians.
Many thanks, Fred Kimotho. And what he has said is just telling us that if you look at Finance Bill 25, the draft that we saw earlier, and you compare with Finance Act 25, critically paragraphs 155 to 164 were dropped. And that means that pharmaceutical inputs and raw materials, transportation of sugarcane from farms to milling factories, locally manufactured phones, solar and lithium-ion batteries, electric buses, and tea and coffee packaging material remain VAT zero-rated. That the implication here is that the manufacturers will be able to claim the input VAT component in their production process. Let me cross over to Jilna with a different perspective on this. Jilna, at the core of this, do we fundamentally have a policy conundrum? Because if you go back to the VAT Act of 2013 and the build-up to it, the reason why we had the conversation around the VAT Act of 2013 was because we had the very problem we're dealing with right now in terms of too many goods being exempt, too many being zero-rated, and we needed to do a cleanup. And we seem to have regressed over the last 12 or so years. And Treasury argues that we have a disingenuous problem in the industry because 30% of all claims in terms of VAT refunds are fraudulent. That is the National Treasury. That is not me. Do we have a policy problem here, Gilna?
Yes, I think we do, because we are also not providing any stability. If we look at from 2013 till now, even if you look at the last one, which was up to 2023, that's 10 years. Over the 10 years, you can barely recognize the original VAT Act that we had, which was the 2013. And remember, a lot of thought had been put when that act was actually done. And over the years, I could say a lot of lobbying, or you name it, every year there's a change. In fact, some industries have seen their products going from exempt to 0 to 16% to back to exempt. So it's even making compliance, I think, very difficult for taxpayers. And to an extent, it causes an issue of, I would use the word, erroneous claims. I know you've used the term, the National Treasury has said that there are certain refund claims which are leading to these fraudulent claims. I don't know how much of that, I would use the term fraudulent, that's a rather strong term, but could that also be arising partly from the fact that people can also be non-compliant? Remember, people might not even be aware that there is a formula that you're supposed to use when it comes to claiming of VAT, like your 90-10 formula. For example, there might be an issue of genuine case of, I don't know, I've bought from my supplier. I don't know whether he has paid the tax. So that's the challenge I feel taxpayers are having. Although there is the argument of, I think it's called the missing trader, right? That's been the ongoing reason why the National Treasury is saying, or KRA is saying, that there are these fraudulent claims, I would say. But I don't know if that's the correct term. I cannot verify the claim. And also, remember, there is the refund audits that KRA does. I think that should be enough. And the whole fact that now we're moving towards digitalization, I propose that should avoid this whole issue of incorrect claims, because now there's visibility on the other side very quickly because of real-time information sharing, that whether there is a fraudulent claim or the likes or of such sort. But I think in terms of a VAT cleanup, Julians, I would say it is very much needed, because we just need a stable regime for investors. Right now, to tell an investor that what they're planning to supply, 1 year it's in, 1 year it's not in exempt, it's moving to 0 rated, it's also causing a bit of uncertainty whether they should come here, invest, because how is one supposed to determine? In fact, we have found a lot of areas where there's errors occurring in this instance. So I think, yes, we do have a problem, and it needs to be, and everything that comes in, remember, we have a national policy. What is the actual agenda of where are we headed? Which sector are we planning to promote? Right now, it's all over the place. If it's looking at manufacturing, then let's work towards which sectors are we planning to grow. Right now, I see no clarity at all where the economy, in terms of where are we headed, which sector are we promoting, which will internally lead to that growth that we are seeking. And if that's the case, let's incentivize those sectors. But I feel right now it's all over the place. We're just trying to, I think, clean up anything. Even this act was supposed to be a cleanup. I don't see it having achieved that still, based on what we have just seen. It's, again, more sector specific and just a few sectors, to be honest. Like you'll see the mosquito repellent sector has been affected, and the Kenya Defense Forces, for example, those are the ones I think they've tried to target, and the tea sector. So that's my comment there. Thanks, Julian.
Thank you, Gilna. And just to highlight that when Gilna talks about the formula to be used for claiming, she is actually referring to Section 17 of the VAT Act. If you go there, you'll see the apportionment formula. And when you had the Tax Laws Amendment Act of 2024, one of the subjects that we had a lot of debate on was the subject of the apportionment formula. Crossing over to Agnes, and as you comment on whether we have a policy predicament here from a VAT architecture standpoint, one of the things which really stood out here was the introduction of Section 66A, empowering the authority with the clawback powers in the event that there's a suspected abuse of the preferential rates of exempt status and 0 rated. What is that? What do you make of it? Is it a step in the right direction?
Yes, the Finance Act now provides that any entity or taxpayer who had been given exempt status or a preferential rate and uses it for inconsistency transactions KRA has the powers to come back and claim back the VAT at the standard rate at the time of disposal, at the time when you committed the inconsistent transaction. I think that is a good move and towards the right direction. And especially when now we are talking about 30%, as you mentioned, VAT refund cases being seen to be fraudulent. As much as we cannot verify that information now, we do know there has been a lot of challenges with VAT refunds, both on the side of taxpayers and on the side of KRA, whereby there has been a long period whereby taxpayers submit all the required documents in their view and still do not get their refunds approved, or even in situations where they get their refunds approved, take a long time to receive the funds. As we are seeing this move or this thought that there are fraudulent application of VAT refunds, it's a good law for us to have in place that will cater for that, so that the people who are using inconsistent or fraudulent transactions to claim for VAT refund do not expose or deter people whose claims are valid and legitimate from having their VAT refund claims approved from the KRA side. And just to mention also on the different changes we are having, and especially the changes moving year on, year out. The rates changing starts with it being standard rated, then comes to zero rated, after some time goes to exempt. I do agree with Gilna that this causes confusion to our taxpayers, and even worse for investors who would want to come and start up their businesses here in Kenya. For example, I would assume before an investor comes, they'd want to do a strategic plan or a survey of the factors that are going to affect their business, and even have a budget, or I would say a projection of the profits, or by when they'd expect for them to break even in their investments and all. So if by the time they are making a decision to come and invest in Kenya, something such as the mosquito nets, raw materials on mosquito nets, zero rated, as it were before this Finance Act of 2025, and then that changes to exempt, it means they will no longer be able to claim the expenses that they incur in production of such mosquito nets. So it's good that we have more stable laws or more stable provisions. And as Gilna was alluding, we can have them sector-based. And we know that if I invest in this sector, I will be able to expect such a rate. And even if it's for a period of time, let's say 5 years, so that it also enables businesses to be able to operate and go on with what they intended from the onset when they started the investment process.
Agnes, allow me to just jump onto the point you mentioned there. On Section 66A, because I take a different view, because there is no guide as to what will be the procedure of the Revenue Authority arriving at the potential abuse by a taxpayer. Don't you see that as a potential leeway for overreach by the authority, Agnes?
Yes, Julian, there are possibilities that there could be misuse of that provision to even punish maybe taxpayers who are still doing the right thing. But the good thing is that with such a provision, it also helps to deter many taxpayers who may be using the fraudulent method to claim or to have their goods at lower or preferential VAT rates. And I think maybe what we need further on that, just to guide the provision of Section 66, is probably guidelines on how the review will be done by the KRA, or the parameters that will be used to be able to determine what is it that was inconsistent or what is it that was misappropriately used when claiming or conducting your businesses at either zero rated or exempt status.
Thank you, Agnes. I'd like us to close our conversation on VAT and just throw an open question to the floor. Either Gilna or Frederick, you can take it. If you look at the MTRS by now, we should have seen the VAT rate coming down. We should have seen the threshold being bumped up. Considering the limited window we now have left for the implementation of the medium-term revenue strategy, do you see these proposals ever materializing, or is this something which now we just forget about? Fred, you can go first.
But Julian, thanks for that question. If you remember my comment earlier, I did mention that sometimes I think we set ourselves for failure when we came up with a medium-term revenue strategy, because we do not appear to have really thought through some of the proposals that we put in there. Actually, not proposals, because they are already in force. Because when you say, for example, you reduce the corporate income tax rate from 30% to 28% by this and that date, you talk about the threshold, you talk about the VAT also reducing from 16% to 14%. You then wonder whether there was a bit of research that informed those particular pronouncements. Because what we have heard from the Cabinet Secretary in charge of National Treasury, and I'm sure, Julius, you have heard him speak about it as well, is that these proposals were actually there in the finance bill when it was being considered by National Treasury. But when the simulations were done, it was noted that the revenue impact was going to be very major. There was then the thinking that we should shelve the idea of using the VAT rate, for example. Also, review of the PSU1 BADs. I think there has been a conversation that they should be reviewed. conversion was that it was going to have a very huge impact on the revenue. You then wonder whether that impact had not been foreseen when the medium-term revenue strategy was being drafted. But having said that, I think the reason we have been given by the CS is that there is a lot of measures that have been proposed or that are being implemented by the Revenue Authority. So I think what the government is doing is a wait-and-see approach in terms of whether those administrative measures that have been recently been introduced, including things like e-teams, will bear the fruit that they're expected to bear, so that then there's a bit of upsurge of the revenue, and as such, when you eventually reduce the VAT rate, for example, there is going to be a compensation of some sort, so that then you don't reduce the VAT rate, and yet also the administrative measures have not yet yielded the fruits that they were supposed to yield. So I think that is what has been told to us. But having said that, I do think that it is not good for us as a country to pronounce quite a number of significant things that we intended to do as far as our tax policy is concerned. Then we start backtracking and giving other reasons as to why we are not able to implement them. We are now left with 1 year. We just hope that we can see most of the changes coming into effect next year. I truly believe that some of them will come into effect, although maybe not of them. Also considering that we'll be going into back to the voter by 2027. So it's likely that some of those reduction of rates will come in handy in terms of convincing the common man.
Thank you, Fred, for your thoughts on VAT. And I'd like us to close our discussion on VAT at that point. There's a lot more on changes to the Value Added Tax Act. Please, you can interact with the Finance Act 5 and see what is exactly provided there. Switching gears to the Tax Procedures Act. Vilna, I'm sure we were all excited to see two provisions being dropped. One was granting the Revenue Authority access to trade secrets and personal data. Another one was on issuance of agency notices despite appeals by taxpayers. They were dropped, but just speak to us in terms of the significance of them being dropped from the Finance Act.
I think the issue of trade secrets and personal data, there was a lot of outcry around the same because some of the industries have a lot of sensitive data. So we were not sure what was the reason of the KRA also having such personal information, how the data would be obviously stored or captured, and then what was the use of that data in the first place, because it's so sensitive. And then also trade secrets. We don't know who's going to be handling that with the utmost care that it needs. So I think that has been one of the biggest wins, I would say, at least in the Act that we have seen. And also for the agency notices, it would have become a bit of you have to pay to play the game type of a situation if we had these agency notices issue there, because enforcements and the likes would be quite rampant, as we can see. So the fact that now at least I can appeal without that stress of having to put money aside, because some of these assessments, as we have seen, Julian's, in the past, are not even making sense. It's not even the turnover of a company. And what we are seeing lately is some really rampant assessments that are being given by KRA. So it would go a long way for a taxpayer. At least they get a chance to fight the case to whichever level that they want to and dispute. For a taxpayer, it's important that they get a chance to fight their ground. I know on the other side it was that because people don't want to pay, they'll continue fighting us. But it could be 50-50, as we have seen in terms of the cases at the moment. But 50 maybe won by KRA, 50 by the taxpayer. But a taxpayer still has to have a fair right to go and fight in any assessment. So I think by having this agency notices issue drop, it will help the taxpayer for sure. Although it's not in line, other countries, in our neighboring countries, are doing it. I don't know, maybe it's only a matter of time, maybe till we play catch up, but at least for now, it's a big win. Thank you.
And that was my quick rider, Gilna, because if you look recently, Uganda just introduced the 30% mandatory deposit if you're going for an appeal. And there's a sense in which across the region that perhaps, and authorities have tabled this argument, there is a prevalence of what they call frivolous appeals and petitions by taxpayers. Does that argument fly for you, Gilna?
No, it doesn't, because I feel it's more the frivolous assessments, I would call it. Because if you look at, from experience, they found even an assessment being more than the turnover of a company. Like, how does that work? How can a tax assessment be higher than even a turnover of a company? It just doesn't make sense. So to me, it could go both ways. Yes, where there's a genuine case of serious issues by the taxpayer, then fair enough. But how much of it? Because of the fact that now we are on e-teams and everything, and then this whole digitalization, how much can a taxpayer also be not paying taxes? There's so much more visibility, which now the Revenue Authority has. So in my view, I don't think that statement would be accurate, as I would say, from the other side.
Many thanks,
Thank you.
Shilpa, for your thoughts on those two provisions, which delightfully were dropped from Finance Act 25. Agnes, from my reading, Section 47.1 seems to have been amended rather to permit the set-off of refunds against import VAT due. Help us understand why this is a significant development and what it means for taxpayers.
Yes, the TPA, the Tax Procedures Act, has provided that we can now offset your taxes instead of claiming your VAT on imports or offsetting it against only your output VAT. You can also claim to offset it against other taxes. This is a good move, and especially for companies that have huge VAT credits arising from import of purchases, because it then would enable them to manage their cash flows. Because in an instance whereby there is a huge import, for example, companies that would require to have a huge setup for them to start their businesses, giving, in this case, maybe a manufacturing plant, it means they would have maybe a very huge import to make, and there's that have a really huge VAT input credit. And now allowing them to offset other taxes against it would help them manage cash flow and probably be able to focus on other operations of the business on the onset. The good thing about this provision is that most of the time import or verification of VAT credits that arise from imports, most of the time is usually a bit cleaner compared to other input VAT credits that may arise from local purchases. So I feel like it's a good move that the KRA has decided, or the law has decided to bring in this provision, because it's going to support many businesses and help them manage their cash flows. And also it's a provision that does not come with huge and especially procedural, I would say, verification processes just to determine whether the input VAT being claimed is legitimate or not.
Certainly, that was quite a breath of fresh air being seen coming through there, the Finance Act of 2025. Fred, we have seen two instances where the law is being amended to clearly provide that the National Treasury has a 6 months window within which to provide regulations for, one, advanced pricing agreements, and two, significant economic presence tax. Help us understand why we are having this 6 months being actually embedded in the law.
Very well, Julians. And maybe if you allow me just to add a few comments on what Agnes has commented on. You would recall that the Tax Amendment Act of 2024 did amend Section 47 and included something called input tax. So what is happening, Julians, you have players in the sector who actually do a lot of import, and they also do a lot of export. So they end up having a lot of claims, which they are then, because of the constraints from the government in terms of giving them the actual cash, their refunds remain with the KRA for a long time. Because I hear, like for VAT, I think the maximum amount you can get per month, I don't know whether it increases with the taxpayer, is like 30 million. You can imagine if you have a billion in form of VAT refunds, or say even 500 million. So it then means that you got to wait for a very long time. And remember, this number is piling up every year. The options that are left in leading Section 47 is that you can only then utilize that in terms of offsetting against other taxes. The ones that the KRA had acknowledged are majorly the pay as you earn, your domestic VAT, another thing like withholding tax and withholding VAT. But VAT on goods imported was specifically not being allowed in terms of the offset. So you have companies that even when they try to utilize the offset option, because of the linear taxes that they are paying on this other side, they still ended up having a lot of money stuck with the government. And that's the reasoning then to say, can we also bring VAT on imported goods, so that then these companies that are heavily on importing, for example, raw materials, and they're incurring huge VAT, they don't end up paying VAT on raw materials when they import, yet the government has a lot of cash that they are still holding. So when it was introduced last year, there was a technical hitch in terms of what input tax is. And as a result, the government never implemented it in the system. But we hope now, with the credit that has been provided as Section 47, the government will enable taxpayers to be able to utilize their refund that is already approved against VAT on imported goods. I hope we get there. Now, moving on, in terms of the 6 months, and something is almost laughable here, Julians, because you realize that we are saying that we will give the government 6 months to provide regulations for SEPT, or significant economic presence tax, from the time significant economic presence tax was actually introduced, which was on 27th of December of 2024, which then technically means that as we speak, we should have those regulations. They're actually time barred already, because we are already 6 months after the law came into force. So then that means that the 6 months, maybe there could have been a drafting issue. Maybe it should have started counting from 1st of July so that you're going up to 31st of December. But having said that, from an advanced pricing agreement, I think it's a welcome one, because then it does give the government the time to ensure that they look at those regulations, they subject them to public participation, and when they come into force, then everyone accepts them. The only question, Julians, is whether we should have pegged the effective date of these particular registrations to the time the regulations come into force, because it is absurd that you implement a law, it is in force already, but the regulations will be published in 6 months' time. So what happens in the intervening period? Does it mean then that you can fail to comply and move scot-free? So there are those questions that someone might ask, but I think it would be good practice to peg the effective date of these laws that require regulations to the date that the regulations are also published. But the other thing that you'll also notice, Julians, is that, for example, for SEPT, or Significant Economic Presence Tax, the language that is used under Section 12E is that of may. The Commissioner or the Cabinet Secretary may publish, which then means that there could be a case for the government to argue that even if the regulations were not in place, we expected you to actually comply with SEPT, which obviously then would bring in some sort of disputes. But as I said, I think it's good practice we review this effective dates. Julians.
You raise a very good point there, Fred, because one of my submissions in the previous public participation exercise to the Finance and Planning Committee was that the effective dates of any provision should be pegged on the visibility of the regulations guiding the implementation. If you remember the experience we had with ETINs, it was absolutely chaotic because there were no regulations, and here we are still being expected to comply. But it hasn't been all hunky-dory on the Tax Procedures Act. Gilna, speak to us about the increase in the number of days for KRA to ascertain a tax refund from 90 to 120 days. Gilna Shah.
So for refund applications, the KRA, where they have, say, for example, an audit ongoing, then the refund processing window has moved from 120 days to 180 days. And where there is no audit, say they opted not to audit, then the refund commissioner's decision has moved from within 90 days to 120 days. So it's actually cushioning the commissioner the time to ascertain their refunds, basically. So obviously it's a hit on the taxpayer because the cash flow gets affected by the additional, for example, 60 days where you're under an audit, or another 30 days if you're not under an audit. So it's just increasing the cash flow burden that we already have in the system.
Yes, Gilna, we are likely to see some hits there on cash flows. We hope it won't be too bad. An open question now as we close our conversation on the tax procedures is on Section 77. And I think the question of computing the time for filing an objection and whether we are including weekends and public holidays or not, this was a matter of intense debate. Agnes, Fred, maybe let me start with you. What are your thoughts on what we have finally seen in the Act? And why is it important, by the way?
So the provision that allowed that weekends and holidays, even public holidays, be part of the counting of days when we talk. And in this, the most recent one that Gilna has talked about, the 120 days that the KRA has been granted to review applications. I'd say, what about the holidays that came in between that were not expected? I remember either this year or last year, we had a tree planting day that was not initially in the calendar. And also, there are a number of clients that were missing deadline in terms of applying or submitting the objections, and even from the KRA side, the KRA giving a status of their review, or the KRA giving their opinion on the objection that a taxpayer has lodged. So excluding or having days extended, for example, in this case for KRA's chance to 120 days from the 90 days, I think it's better to have it this way as opposed to have shorter period, 90 days like in the previous case, and exclude the weekends. And mostly because of the ambiguity that comes with any changes that may appear that were not expected as holidays, especially holidays, because weekends are constant. In my opinion, it's better that we have an extended period that covers both weekends and weekdays, so that we are talking of calendar days as opposed to working days, because the working days was bringing a lot of confusion, both to the taxpayer side and to the KRA side. And in instances where we were dealing with high assessment, and the law provides that you will be deemed to have accepted an assessment if you do not lodge an objection within the set limit or the set number of days. For some taxpayers, it was detrimental. So excluding the weekends is a better provision for both KRA and for taxpayers.
Certainly eases the administration burden there. Thank you so much. Fred, did you want to come into that point?
Yes, sure, Julius, I could do that. And I agree with Agnes. You will recall that, and especially this one of excluding weekends and public holidays, it mostly applies to objections and appeals. So before 27th of December of 2024, we used to count the number of days. For example, for objection, it used to be 30 days. We used to count the calendar days. So it used to disadvantage taxpayers, especially when we have very long public holidays. I remember before this, you could be breaking for Christmas on 24th, and that is when actually most of the assessments used to come. So by the time you're having your Christmas holiday, you're already worried about the number of days that are already moving with a bit of speed. So then to that extent, there's a relief to taxpayers, because then you can be comfortable that you can enjoy your holiday and come back and deal with your objection or the appeal, which is a good thing. And of course, Julians, also cases have become a bit more complicated. So it requires a bit of more time to just put things together. And the other thing that you actually notice, even from the judgments of the TAT, increasingly we are seeing a lot of taxpayers losing the cases because of what we call supporting documentation. Excluding weekends and public holidays then will allow the taxpayers to put together the documentation that is required to support the appeal or the objection. But having said that, Julians, I think it's also important that we look at this more critically. It's probably fashionable to defend that weekends and public holidays should be excluded, but I think it is also good to ask ourselves whether there are some other negative impacts that this one may come with. And one of them that I see, we have just come from Gilna telling us the implication of increasing the number of days from 90 to 120, from 120 to 180 for refunds, which I think, if I hear us correctly, what you're basically saying is that it may have a negative impact on taxpayers because it may constrain the cash flows. Now, the question we need to ask ourselves is, why are we increasingly looking at these days? Because from a taxman perspective, the taxman may then say, I want to increase the numbers from 90 to 120 days. In any event, you also have been given more days as far as the objection is concerned from 30 days, and you have excluded weekends and public holidays. So as a result, we are likely then to see timelines just being reviewed negatively to the taxpayers, negatively to the revenue authority as well. So in my view, where the timelines are working, I don't think we should touch them. The other thing that you'll actually notice, Julians, and if you look at history, you'll notice that some public holidays just come up. You know, there's a tree planting day. So the question then is whether we'll have someone who is behind configuration of ITAX updating this very regularly, so then you don't end up with penalties and interest that are erroneous just because someone did not update a public holiday that was declared. Because the practitioners in the call will tell you, getting penalties and interest removed from the system when they have already been imposed is actually probably harder than the sacrifice you would pay for just spending an extra day to prepare that objection or prepare that particular appeal. So I think the question on time, we have to think about it more comprehensively. And in my view, when days are working, I think let us retain them the way they are without necessarily looking at them again.
Fred, we can have this debate, and we've had it in the past until infinity. But let's close it at that. Let me take two questions which I'm seeing online. The first one comes from Robert Ferrero. This issue of the 2.5% withholding tax on freight income. How will KRA assess and collect the 2.5% withholding tax on freight income? And there's another question here being asked on the Tax Procedures Act. Shouldn't we have seen the amnesty being extended? That's a funny one. Maybe we can start with that one. Gilna, should we have seen the tax amnesty being extended?
I think we need to see how much has been collected to justify a case, hopefully in the next bill. But as it stands, I saw that there was a lot of last-minute rush, even from the KRA, to close all assessments so that taxpayers could take advantage of the amnesty. But at the moment, the sentiments, or should we say the comments that we received was, why should we continue? Because we will never otherwise close at any point. We will always end up giving amnesties. So I think in that sense, we also need to comply as taxpayers. So just to ensure we don't always get cushioned by the fact that there's always an amnesty. I did also pray, we also pushed for it, but it didn't come through.
Maybe actually the question I had in mind around that was that now that we had ITAX collapsing on the last day, we having the amnesty being extended equally to July 5th. If you look at ITAX, it looks like a different story. But anyway, Agnes and Frederick, who can help me on this issue of the 2.5 withholding tax on freight income?
I'm happy to take it, Julius.
Go ahead, Frederick.
So, Julius, if you look at freight tax currently, or rather before the Finance Act of 2025, it was being administered by way of self-assessment. So more specifically, it was imposed under Section 9(1) of the Income Tax Act. So what used to happen is that the agents of the shipping lines were the ones that collecting the data, computing the freight tax and limiting it to the government by the 20th day of the following month, which was a very straightforward way of looking at it. If you look at the number of agents we actually have for the shipping lanes, I think they allowed 47 when I last checked. So that then it was easy for them to do that. And I think that is where Lombat is coming from, because then we are saying what the Finance Act has done is to remove this obligation from the agent, has taken it to a withholding tax mechanism where we are now saying that the person paying the shipping line, which is an unresident entity, the freight tax is the one who is supposed to then compute the freight tax and limit it by way of withholding tax every 5 working days. And if you look at this, the number of people that were expected to limit this particular tax is unimaginable. I would imagine they are in thousands. So the question then would be, is it easier to administer it when it was being done by the agents by way of self-assessment, or it will be easier now that it will be done by 1,001 payers to the shipping lines? And Julians, we did engage the finance committee on this particular one. And where we're coming from is that we thought that moving this from a self-assessment regime to a withholding tax regime would actually most likely lead to leakage of tax. But then I don't think the proposal was actually taken. That's why we are having this conversation. But we hope to see maybe the impact as we go into the new year. But having said that, it's also good to mention where the government is coming from. If you look at Section 9.1, you will actually notice that there's some ambiguity as far as this tax is concerned. The law does not put the obligation on the agent squarely, because even when you look at Section 47 of the Income Tax Act, there would have been an argument that the agent is actually not obligated. And the other thing actually you'll also notice is that this particular piece of registration did not have a deadline. So there was no like, you're supposed to remit this freight tax on a certain day. So I think based on those two major things, that the government thought it is good to introduce something that at least will impose the obligation on a certain individual, and also most importantly, put a deadline to it, in which case then they move from a self-assessment to a withholding tax regime. But if you ask me, maybe what should have been done is to put a bit of muscle to the Commissioner of Domestic Taxes for them to be able to enforce the self-assessment regime, which I think was already working perfectly.
Thanks, Fred. I also struggled with it because it looked like the government was very keen on getting some agencies to play the collection role. But again, the cost of administration versus the yield that will be realized is something we wait to see. Time is fast spent. We need to switch gears to income tax and possibly excise if we'll have a minute. Agnes, help us understand advanced pricing agreements, one of my key highlights in Finance Act 25.
Thank you, Julian. The advanced pricing agreement will ideally simplify transfer pricing documentations with the KRA. We've had a series whereby companies or entities have transfer pricing documents or transfer pricing policies in place. And to give as an example, we'd have maybe a margin, a profit margin, say of 5%, and the company would be operating the same, say for a number of years. And the KRA will then come, and after they do the assessment, they decide that they need to revise such a margin upward, say to 7.5%. The question has always been from the taxpayer side, since they do have a transfer pricing document, and I believe it followed the strict method of the preparation of a proper transfer pricing documents, but the KRA has a different view. And of course, benchmarking analysis may differ from time to time based on the data that has been used. So you'd find situations whereby as much as a taxpayer has not willingly avoided tax, they'd find themselves with tax assessments or tax arrears that the KRA may impose on them. Advanced pricing agreements will come to solve that, because it means that even before I trade, I'll be able to enter into an agreement with KRA and probably agree on the 5%. And as I operate my businesses, I will know that from a transfer pricing perspective, I am covered. They are limited up to 5 years as per the provisions of the law, which I think is a considerable period for businesses to change or for the matrix in the industry to change, which then means a revision or an update of the transfer pricings can be done, and then a new or a revised agreement can then be entered into with KRA.
Thank you, Agnes. And I think also it's important to highlight that between Finance Bill and what we are seeing in the Finance Act, there was the adjustment that in the event that you're found to have entered an advanced pricing agreement on fraudulent or incorrect information, then there will be consequences coming from the Revenue Authority. Gilna, there was so much debate around Finance Bill and significant economic presence tax and whether we should have the 5 million annual turnover threshold or not. What finally carried the day, and where do you lie on this debate?
First of all, I wasn't even sure when significant economic presence tax was introduced and this 5 million threshold was even introduced. It just did not make sense to me from if I look at it, remember this SEP tax is applicable to non-residents. And if you convert 5 million into USD, it just was a very small amount for them. So they would anyways be caught in that bracket. So I just never understood the limit in the first instance. Anyways, we are where we are. This limit has now been removed, so it will be applicable. I think they've aimed for this SEP tax to be applicable to all non-residents that are in that space. They've even expanded the significant economic presence tax, which was initially limited to the digital marketplace, to now any services that are supplied over the internet or electronic means. We're yet to see the application because, as I think Frederick has already said, the regulations and the fact that there is a whole May around this, whether they will publish these regulations, we're yet to see. So it's caused a bit of confusion even for non-residents when they query this tax. But we are yet to see any clarifications on this. And how successful it's also been, we are not sure at the moment as we speak.
Thank you for that, Gilna. And coming over to Fred, one of the things which I raised in the debate around finance bill was, should we be debating fundamentally about the rate of significant economic presence tax as opposed to whether or not we should be having a threshold? Because as Gilna said, and I fully agree, the 5 million just didn't make sense to begin with. Fred?
As far as the threshold is concerned, in my view, I would think that maybe there is need to have a threshold. And the reason I say that is because sometimes, and I think Jill, as you just mentioned that in our previous discussion, that sometimes you've got to look at the costs of compliance versus what the tax that whatever is yielding. The fundamental problem that I think came in with that particular proposal is that the 5 million threshold was not clarified whether it was jurisdiction-based or it was worldwide revenue. So if it is going to be worldwide revenue, which is what most of us did interpret it to be, because in the absence of that clarity, then it was always safer to interpret it that way, then it means that threshold that was under Section 12 was as good as non-existence. And I think that is where Gilna is coming from. But what about saying that we specify in the law that yes, there's a threshold of 5 million, but that 5 million is based on the revenues that the non-resident company makes in Kenya? Because you can imagine if you're making less than 5 million, sometimes the cost of hiring a consultant because you're not here, that headache of trying to transfer money, sometimes it may just outweigh the benefit of even the government receiving that amount. And we have actually seen taxpayers who are in that category. So for me, I think they should have clarified, and we did submit on that, them to clarify whether it's jurisdiction based. And actually, if you look at the best practice jurisdictions, look at countries like India and even Nigeria who have implemented this set, you'll actually notice that they have thresholds, only that in their respective jurisdictions, they have been able to specify and make it very clear. And also the 5 billion, whatever number, is also well benchmarked to ensure that you are achieving the objective that you need to achieve and not just throwing out a number there that you may end up not achieving the objective that you're going to achieve. But having said that, I think SEPT is an area that is growing. We are likely to see many changes. Maybe this is the next exempt and related things that we will be seeing each and every year. I don't know.
As you can clearly see, we are still not agreeing on this matter, even on this discussion. Agnes, where do you lie on this debate of SEP tax and the threshold?
I concur with what Fred and Gilna have raised, and especially when we talk of the threshold, are we referring to what you earn in Kenya, which would make a bit of sense, or are we referring to the income that the company earns from a global perspective? So my second question would be, this is coming after the repeal of DST and the formula of SET being the 30% times that the resultant rate being 3%. So the question we ask ourselves is, before we even came with this amendment of the Finance Act of 2025, SEPT had been introduced through the Tax Laws Amendment Act. During the 6 months period, how much has the revenue authority collected from this specific tax? So that now we are able to weigh, as Fred was pointing out, the cost benefit of it. Because this is an non-resident, they're out there. There's the transactional changes, the exchange rate expenses, them needing to hire someone who understands taxes in Kenya and all that. What are the cost benefits of it? I feel like as much as it's a good tax because it broadens the tax bracket, there should be clearer regulations. And I think we wait to see, as you were mentioning, we're already late. The law started in December. 6 months are needed to have regulations. So I think we wait to see that the regulations will provide more clarity and more considerations, and especially in this space where non-residents are not in Kenya yet, they are required to submit a tax that is in Kenya.
Thank you very much, Agnes. And we would like to close significant economic presence tax at that point. Let me come back to Fred. One of the things which almost surprised, I think, a good number of us is that when we saw on the floor of the House, Section 12F of the Income Tax Act being repealed, and we have effectively done away with the digital assets tax, something which came about very recently via Finance Act 23. Fred, where is the government coming from with this, and did you see this move coming?
I was actually surprised to see the repeal of digital asset tax, considering what we have just mentioned. I think it came into effect on 1st of September of 2023. So it means that we have not even hit 24 months since this tax was introduced. What was in the finance bill was actually a reduction of the rate from 3% to 1.5%, which was then speaking to maybe the outcry that has been out there. But having said that, Julian, I think there was a fundamental challenge or problem with the way this particular law was drafted. If you recall, the 3% digital asset tax was actually based on the transaction value. What it actually meant is that the owner of a platform where you're exchanging some of these virtual assets would be required to limit 3% on the amount that has been transacted, which basically means, if you are to use an example of a bank transfer, if you are transferring $1 million, then that 3% is based on the million that you're transferring. You can see a problem right there, because the million does not necessarily mean that it is income that you have derived or accrued from Kenya. It actually may mean that whatever is being transferred, you have actually made a loss in a certain transaction in trading of some of these virtual assets like cryptocurrency. So there was a problem right there in terms of the way the same was drafted from the word go. And I think when we were doing these submissions, we saw quite a number of players in this particular sector trying to plead with the government, look, we are actually probably even taxing capital. And I think that is when there was the thinking that they should review the base. If you look at how this digital asset tax is actually done in other countries, or how virtual assets are taxed in other countries such as France and even the UK, mostly it is either business income in terms of how much has someone made from a certain transaction. Say you have traded a cryptocurrency, how much have you made from that particular transaction? So you pay either capital gains tax on the gain that you have made, or you actually pay business income. If you're an individual, you subject the gain that you have to the pay brackets, and then you pay the tax, which is what the best practice dictates. But I believe the review from 3% to 1.5% was in recognition that maybe the government is still doing a bit of research to know how this sector should be taxed. And I understand there is actually a task force that has been set within the Revenue Authority for them to do a bit of research and see what is the optimal way of taxing this particular sector. But I think the key thing also to mention is that though digital asset tax has been dropped, I think we have seen the introduction of excess duty on the fees that is charged by these owners of platform. That is the virtual asset service providers, which is, I think, at the rate of 10% on the fee that they do charge their customers. So I think there will still be some sort of revenue there. But I expect a lot of noise as far as taxation of virtual assets is concerned in the next few years as the government tries to put their finger on how this sector should be taxed.
As a matter of fact, we have the Virtual Asset Service Providers Bill, which has just gone through Parliament and is still actually in the House going through the rigors of the legislative processes. We shall keep an eye on that to see how that pans out. Taking forward our conversation on income tax changes, let me come to Gilna. And we have seen changes on investment allowances for investments of $1 billion shillings plus, and for hotel buildings and buildings for manufacturing. That had been proposed for deletion, now being retained as per the Finance Act. How crucial is this, Gilna?
I think the fact that we are looking at deletion of the 100% allowance on investments that are very capital or intensive, such as your buildings for manufacturing or hotel buildings, we are looking at millions. There was also investment in an SEZ that was also proposed to be deleted. So that means there will no longer be any allowance on that, and it would revert back to the normal rates of investment allowances. So because it was specific to manufacturing sector, all these would have been heavily affected, obviously. The fact that they've actually been retained gives comfort that you can now claim the 100% allowance. However, on the flip side, remember, you can claim 100% in that first year of use once you make that investment. But remember, if you invest billions, your claim is in billions in terms of the capital allowances or investment allowances, as we call them. Remember, your tax losses have now been obviously curbed at 5 years. So the maximum that you can carry forward is anyways limited to 5 years. If it's huge and you're not able to recover the 100% claim, say it takes around 12 years or 10 years to recover that over time, then from year 5 only you'll not be able to recover, since your loss would be capped unless you make a specific application to the cabinet secretary for another extension of 5 years. But that would be now on a case-by-case basis. So there's no guarantee. So how comfortable would an investor, a foreign investor, be who is investing billions, say, in an industry, and then you're telling him that, okay, the maximum that this can be carried forward, because by the time you recover, is only up to 5 years, because then we have the tax loss issue also coming in. Julians?
Jill, now that you've touched the issue of the carry forward of tax losses capped at 5 years, we have been here before, and I've struggled with where the government is coming from with this adjustment, because this was the case earlier from 2009, I think, and then we had to adjust it, and to the point where we were in 2020, where it was now carried forward almost in infinity. And here we are again. Where exactly is the government coming from with this?
I think I'm also baffled, because I would also like to see how many companies are actually in a loss that goes on beyond, I would say, 10 years, to be honest, because it's very rare to find someone who's always in a tax loss position. It's a very handful maybe of industry or taxpayers that would come in that bracket. But a majority of them, if you look at the capital intensive industries that we are now trying to say, let's bring in foreign investors, let's put in investments in the economy, we're looking at a lot of money that you're expecting people to put in, and you're saying to them, we're curbing this loss. So what are we really attracting? I don't know. But the basis that many people are not paying taxes, but you see the taxes are still being paid in terms of PAYE, VAT, import duties, you name it. There's still another portion of tax that is still being collected, if not CIT, for example, from that industry, for example, who's saying that tax loss position. But I'm yet to see any data as to how many taxpayers in reality are we really talking about.
Frederick, Agnes, any thoughts on this carry forward of tax losses?
Yes, Julian, I'd be happy to give my comments, and especially on the tax losses. As you've mentioned, this is one of the laws that has been changing. I think it started with losses infinity, went to 4 years, went to 10 years, infinity. Now we are back to 5 years. So my question is, I'm an investor who made a decision to invest billions of shillings based on the fact that I can claim my tax losses to infinity. Then a few years down the line, the same changes to 5 years. Where does that leave me? And just as Jill now was talking of the window to apply through the CS for an extension, it's a good move as opposed to what was in the bill that only provided for losses up to 5 years, and that was it. But then again, it's not guaranteed, as she mentioned. So when I'm making strategic decisions as an investor, I don't want to base my decisions on something that is 50-50 or something that I'm not sure about. And again, to speak of companies that have huge tax losses, there are companies that have probably been given the investment deductions at 100%, at 50%. So are we giving with one hand and taking with the other? So why give me 100% investment deduction just for you to come and take with the losses 5 years later? And just to mention, these huge companies that actually have the huge losses because they invested huge capital bring more than taxes to the table. They are the ones that will provide employment. They're the ones that will enable the economic status of a certain area to grow significantly. So can we look beyond the taxes that we are collecting and focus more even on the economic growth of the country and the benefits that come with huge investors or high capital intensive investors?
Yeah. Any thoughts on this?
Yeah, sure, Julian. And I agree with Jill and Agnes 100%. When I saw this provision, it's one of those cases where you actually, it's almost tantamount to trying to kill a mosquito using a hammer, maybe just use that phrase. Because when you look at the spirit behind it, the way it has been advanced by the policy makers is that there are companies that are reporting losses year in, year out, and in their thinking is that the books are actually not correct. You can imagine most of the companies that have this level of investment, even the level of audit that they actually go through, leave alone the KRA audits, but even the financial audits. So I don't believe that is the case. There could be one or two companies, but would the one or two companies actually justify allowing tax losses for companies that have incurred that particular expenditure? For me, I do believe that the government should be able to audit such companies, and they have powers under the various tax statutes for them to then assess any additional tax that they believe should have been paid based on the books that are not very accurate. But for me, Julians, I think the bigger problem, and I stand corrected here, and maybe we could look at it, when you look at that particular change, especially on the extension, I see a bit of technicality in there because the Finance Act 2025 appears to amend a section that was already deleted by the Finance Act of 2022. So I think there will be a bit of conversation there in terms of, is that extension even there in the first place? If the Act is actually amending an existent section under the law. So there's a bit of conversation there. And I think there are quite a number of provisions, which then begs the question in terms of our tax laws that we have on maybe Kenya law, whether they're actually up to date or whether there are some still provisions that are existing there and whether they actually need a bit of cleanup. But just, I think that is just for us to think around it. I could be wrong in terms of whether that section actually do exist, but based on my peruse of the Act, it appears like that section was already deleted by the Finance Act of 2022. Julians.
Thank you, Fred, for that. We need to wrap up this conversation in 10 minutes, so I have one question to go. What deals to many of us by surprise were the changes to betting and gaming withholding tax. We have seen the change from winnings to withdrawals and the rate coming down from 20 to 5%. What do you make of this?
Yes, there was the provision that revises the rate to 5%. And also there has been the new definition, or rather the repealing of the term winnings and introduction of the term withdrawals. So the 5% will now be applicable on what the punter withdraws or what the punter is after they have made their bets. So my thoughts on these are, first, when we think of betting from a moral perspective, with the taxes that are in place, are we encouraging betting or are we discouraging betting? And especially when we look at the youth, and I would say the way there has been a lot of, I don't know whether it's right to use the word addiction to betting, whereby there's too much betting of it that feels uncontrollable, which from a moral perspective is not a good thing. So when the tax rate moves to 5% from the initial 20%, my question is, what exactly guides that new provision? And just to also note that even under excise duty, there are also some adjustments on betting, whereby the definition or the amount that is now applicable to excess duty is the deposit. The amount that a bettor or a punter deposits in their phone is taxed outright. So it's like the rate has reduced from an income tax perspective, but then when we go to excess duty, the amount that is being applied tax on has been expanded. I think for me, I still feel like betting is a tax or something that should suffer from something we used to call sin tax, or a tax that is applied to discourage certain activities. I feel like moving it to 5% is not in line with discouraging betting. But then again, when you look at it from the side of excise duty, where broader amount has been covered, I think there's a bit of balance on both laws in the Finance Act.
Fred?
Not much, Julians. I think I do agree with the comments by Agnes 100%. The question is why we keep seeing these changes in this particular sector. And I think Agnes has mentioned quite a number of fundamental things there, including the policy behind this tax. The only thing that I may want to mention is that now we appear to be moving from taxing the winnings, again, the concept of income, and actually taxing even the amount that someone has staked. Remember, the current rule, especially from a withholding tax perspective, is only imposing withholding tax on the gain that you make after betting. Say you place a bet of 100 shillings, you are paid 110, the tax is only on the 10. And I would imagine that is why probably the rate was a bit high. But now the way the law appears to have been worded, it appears like the tax will be on the total withdrawal, which is 110. So if you impose a 5% on the 110, obviously it's a very high tax. But again, this one seems to contradict some case laws that I've actually seen where one of the betting companies has actually successfully petitioned the court and argued that it is not right to tax the amount of money that someone has staked. So I think this is one of the provisions that you'll wait and see how it will be implemented and whether maybe there could be some petitions on the same.
And maybe I can add a comment on the same that, I don't know, maybe perhaps the whole point of doing that is, I think the intention was to collect a lot of taxes. In the previous regime, they did not collect because a lot of these betting companies moved offshore, and obviously also the money moved offshore. So I think just to try and see if this way they can try and retain the money or the companies back to Kenya is probably something that they're intending to do, although I'm not 100% sure if that has been the real intention. We are yet to see on that, Frederick. That's just what I thought was the reason of maybe changing it and relaxing the rate. Although, as you're right, as you say, if you really work it backwards, it ends up being a bit more higher as opposed to a lower rate.
And I agree with Gina, because when you look at the news in the recent past, I think there was a bit of fright in terms of most of those companies leaving Kenya and going up to settle elsewhere. maybe that has also informed some of the changes that we have actually seen.
Mokaya Bogothron on Twitter sometimes asks that he wants us to allow you to give your closing thoughts on this and perhaps also cover some of the other things that may not have been covered so far. We'll start with Gilna, Agnes, and then Fred in that order.
Thank you, Eric. I think for me, in terms of closing thoughts, this act has obviously, from the finance bill, I can see a lot has been listened to from the public, I'll say that. But a lot has also been brought in, which was previously not there. So I think in terms of impact, we are yet to see how it's going to impact the affected industries, especially. I've seen a lot of paper on excise duty sides. There's a lot of add-backs, introductions as well, ceramics, I would say. Even from an export and promotion levy, there have been a bit more introductions, with even the rates being still kept for at least the iron at 17.5. So we're yet to see the impact, obviously, on that industry. And I don't know what the intention eventually was for doing that. I think we wanted to see a proper cleanup done. That was the ask. If this was supposed to be a cleanup, we still find that a lot of the provisions still need a better cleanup, yet that has been left behind. So I don't know if it's just been an interim cleanup, as I would call it, and then maybe we'll see a better cleanup and a move towards, as Fred has also mentioned, the move towards the MTRS, because we're not seeing much time, and I don't find that happening in the next bill if we don't achieve the revenue collections as we see as intended in the tax expansion, because that's the whole aim of the first is to do the tax expansion, but we are yet to see that, if that will actually work. Thank you, Eric.
So for me, my thoughts on the Finance Act of 2025 would be, and in comparison with the bill of 2024 that didn't make it to become an act, one thing that was loud or something that was seen clearly was that there were not many changes on employment income, that is pay as you earn, probably because the effect would have been felt directly by the people, and also probably touching on the reactions that came up from the finance bill of 2024. However, we still note a number of changes that are touching especially companies and specifically investors. So I feel like, are we not focused on having investors come to Kenya, or why are our laws not aligning with encouragement or in giving incentives to especially high capital investors who in the long run result to our economy developing? But besides that, I think, just to agree with Gilna, a cleanup or a betterly done cleanup will be required, just to ensure that the provisions are clear and there are no contradictions in the law. So otherwise, it's an act that we look forward to see how it will be implemented in the near future, and the repercussions that will arise, especially from the regulations that we are waiting to see in 6 months. Thank you.
Thanks to my co-panelists, Gina and Agnes. So for me, it's probably just maybe to appreciate the policymakers in terms of some of the changes that we have actually seen. I think maybe for the first time in a long time, we can actually see some tangible input from the stakeholders being taken into account. I think we already have mentioned some of the proposals, such as the one that was impacting on personal data and trade secrets, the one on agents and notices, and quite a number of other couple changes that Parliament did not accept to move forward, including the deletion of some of the critical products from the first schedule and the second schedule as well, which is a good gesture then, because that it means that someone is listening to us. But having said that, of course, there are some areas of improvement that I believe that they can do, but I think it's a step towards the right direction. I look forward to a day when, as a country, we don't just rely on short-term views and putting things on Excel. Like, for example, saying that if we reduce the VAT rate from 16% to 15%, the impact will be, say, 100 billion, by just looking at what you would have corrected without necessarily considering the wider impact, or what I would call the ripple effects. When you reduce the rate from 16% to 15%, for example, there's also the impact that you are likely to create more jobs, you are likely to increase the disposable income to your citizens, and quite a number of other factors that go in there. So I think we should move from this conversation of just looking at the impact in 1 year and not looking at the ripple effects of a certain change. It was good to see that debate happening in Parliament this time around. And we do hope that we'll, in a short while, find ourselves in a place where we are not very myopic in terms of looking at some of these changes. But looking forward into the future, my co-panelists has mentioned, I think it would be good to see what the Finance Act of 2026 will come with, or whatever miscellaneous piece of legislation we have. But most importantly, We hope to see some of the things that have been mentioned in the medium-term revenue strategy, such as reduction of CIT rate, review of the payee bads, and reduction of the VAT rate, and some other good changes that are expected. We hope to see them come in so that then it doesn't feel like the government is only taking away from the citizens. I think it would be good to see the Finance Act of 2026 will actually be giving back to the citizens, and most importantly also to have changes that are geared towards spurring the economic activity in the country. Thank you, Mokaya.
Just one question, Fred. Looking forward to 2026-27 in terms of planning, where can Kenyans get their voice heard as we work towards the 2026 finance bill?
I think the government has an elaborate calendar in terms of, for example, how the finance bills are published. I think sometimes in November this year, we do expect a call for public participation by the National Treasury, where we then put in our comments in terms of how we would want to see the tax environment take shape. There will then be all our engagements with them sometime in March, in which then they'll publish the bill by 30th of April of next year. And it'll come back to the same cycle in terms of also submitting to the National Assembly and then having the bill go through Parliament and then assented to by the President by 30th of June of next year. So in my view, I think as stakeholders in this particular conversation, what is important to us is then to analyze our tax laws that we do have before us. And when it is the right time to make those submissions, then we engage the right people, and that's National Treasury and National Assembly. So then we can shape the conversation in terms of what we see in the finance bill of 2026.
Thank you. The key takeaway was that there are steps we can take in terms of being heard, or in terms of the various things that you want to change before to the finance bill 2026 is published next year. Thank you so much, Gilna, Agnes, Fred, and our host was Zamboko, who managed to guide the conversation very well. Twitter sometimes acts up, but the conversation was very informative. Thank you, our panelists. Thank you, our listeners, for taking time this Wednesday evening to be able to listen in. On that note, I would say thank you once again. Maybe Fred, Agnes, and Gina, you can also say kwaheri, and then we can close up.
Thank you, Kaya, and kwaheri to our listeners. It was a great pleasure having these conversations. Looking forward to the subsequent ones. Thanks, Mokaya, for the opportunity. Appreciate it.
Thank you, everyone. Thank you, Eric and Amboko, for this engaging conversation. Thank you to my co-panelists. It has been an honor and a pleasure having this wonderful conversation, and look forward to many more. Thank you.
Much thanks, Julians, my panelists, Fred and Gilna. Thank you all listeners for joining in. Looking forward to interact in more sessions in future, even as we continue to understand the laws, the expenditures, and other matters that touch on our economy. Thank you all and have a good night.